Hello, my fellow taxpayer. This is Brant Speshart with Steward Wealth Strategies, and thank you for investing time with us today as we discuss tax planning for 2024. Now, the name of our firm is Steward Wealth Strategies. Steward means stewardship, and we want to help our clients be good stewards of their resources that you've been blessed with. And we think the best client is an educated client, and that's why we hold workshops like this one. We want to make sure that we're providing information that we feel is valuable, meaningful, and relevant. Right now, it's the end of tax season, and a lot of folks have already filed or maybe still working on their taxes, and we're taking care of business for 2023, but now's the time to start thinking about 2024. So let's walk through planning for 2024. So here's the thing. 2024 still has the same 7 tax rates or income tax rates. However, the income ranges have adjusted slightly. So you can see here, we still have 10 to 37% ordinary income percentage brackets, but the income ranges for each has adjusted a little bit. The standard deduction for single filers, 14.6, married filing jointly is 29.2. But if we think about qualified dividends and long-term capital gains rates, those still receive, for the most part, preferred taxation at 0, 15, and 20%. So somebody with a high income could still be paying only 0 to 15% on long-term capital gains or qualified dividends. Now, if you're a saver and you're still in working mode where you're contributing to your retirement, just know the amounts have adjusted slightly for 2024. 401k deferrals have increased to $23,000. And if you're 50 or more, you're also allowed to do a catch up of up to $7,500. So you can save quite a bit to a 401k. And if you contribute to traditional IRA or Roth IRAs, you're allowed to contribute $7,000. And if you're 50 or more, you can do a $1,000 catch up there as well. So potentially up to $8,000 to a traditional or Roth IRA. Now, there could be restrictions that may prevent you from contributing that much, but just know those are the maximum allowed. In 2024, the annual gift exclusion has been increased to $18,000 per person. So an individual can gift up to $18,000 to anybody they want, as many people as they want. And that can also count for a spouse. So a married couple technically could gift up to $36,000 per individual. Now, a great idea if you're thinking about gifting is think about adult working children or grandchildren possibly contributing to a traditional IRA or a Roth IRA. Or if you're a fan of education, higher education, maybe contributing to a 529 plan. 529s really have where you can turbocharge gifts and do up to 5 years at once. So if you have questions about gifting to individuals, especially children or grandchildren with retirement accounts or education, please reach out to your wealth manager here at Steward Wealth Strategies. So we believe a proactive approach is going to generate better results than a reactive approach. You know, would you rather do proactive tax planning or reactive tax paying? You know, an ounce of prevention is better than a pound of cure. So let's talk about opportunities so we can be proactive. So the Secure 2.0 Act, what's formerly known as the EARN Act, but we generally call it Secure 2.0, basically has helped enhance some retirement provisions. So one enhancement was regarding required minimum distributions. The RMD age has now moved from 72 to 73. When Secure 1.0 went into effect, it raised it from 70.5 to 72. Now it's from 72 to 73. And over the next few years, it's actually going to increase to age 75. The other good thing that's happened regarding required minimum distributions has to do with the penalty. If you do not pull enough out of your retirement account to satisfy that RMD, in the past, you've been subject to a 50% penalty. Now the penalty has been decreased down to 25% and possibly even 10%. The Secure 2.0 Act has made provision to allow Roth SEP and Roth simple contributions. Now, just because the act has been passed to allow, just know retirement plan providers, as well as most payroll providers out there, are not set up for this yet. So we'll probably start to see this become a little bit more mainstream over the next couple of years. But the rules have been established to allow it. Now we need to, for the private sector, the providers, to actually update their systems to be able to make this happen. It's going to be a huge opportunity, though, for folks that love Roth, that maybe were self-employed or worked for small businesses that didn't have 401k. Now those types of retirement plans are finally starting to catch up. Secure 2.0 also added a very interesting feature, although it's complex, to 529s that will basically allow, or potentially allow, leftover 529 money to go to a Roth for that 529 beneficiary. Now, it's complex. There's some strict rules that have to be followed. One is the beneficiary of the Roth has to be the beneficiary of the 529. The 529 also has to be in existence for at least 15 years. So that means the 529s had to have been established for 15 years or more. It's got to have money left in it after paying for qualified educational expenses. And then the beneficiary has to have a job. They have to have earned income and qualify to be able to put money into a Roth. If that's the case, then rolling money from a 529 to the Roth is possible. It will count as a contribution, so it's limited up to the contribution limits. And then over a lifetime, it's capped at $35,000. But the great news is, for parents that have been concerned about having money left over, there's now an option to where, hey, there could be a really strategic move with some of those leftover 529 balances. Roth conversions are still one of the best financial planning tools or concepts or conversations we're having or helping clients with. And really, especially when it comes to wealth transfer. So wealth transfers still consider Roth conversions, and wealth transfer is moving money from one generation to the next. So with Roth conversions, we really want to think about family tax bracket management. Are my heirs in a lower tax bracket than me, or are my heirs in a higher tax bracket than me? A lot of times if somebody's retired, they may be at the lowest bracket they've been in decades. And maybe at that point, their children are working, possibly dual income, possibly peak earning years, maybe higher bracket. It may make sense for an IRA owner to consider converting money to Roth, paying tax while they're at a low rate so that their heirs inherit tax-free. But this is something that takes a lot of thought and consideration, and it really depends on what your goals and objectives are. If your objective is to use your retirement money and not leave it as an asset for next generation or possibly spouse, then Roth conversion may not be an important tool for you right now. So reach out to us here at Steward Wealth Strategies if we can talk to you about Roth conversions as a tool for wealth transfer and discuss family tax bracket management. But here's the thing, Roth conversions are great for wealth transfer, but they're also great for the IRA owner themselves or the Roth IRA owner themselves, because the money grows tax-free. And when you start withdrawing, it's tax-free. This is a great way to potentially lower your overall taxable income. The sweet spot is possibly the person that retired before drawing Social Security and they are retiring before starting their required minimum distributions. It can create this one window that may only have a few years to really take advantage of some Roth conversions. So let that money grow tax-free, let it compound tax-free, let it lower possibly your overall taxable income over a lifetime. You also, with Roths, there are no required minimum distributions. You're not forced to pull that money out. Now, with wealth transfer, those rules change, and we'd be glad to talk to you about, some of the implications for heirs when they inherit retirement accounts. Bundling or bunching your charitable giving. This is a really good strategy, especially right now that we're under the Tax Cut and Jobs Act, where we have a really high standard deduction. A lot of folks aren't necessarily itemizing right now, which means they're making charitable contributions, but not getting the tax write-off. That's okay. Hey, why do we give? We give from the heart. We give because we want to help others. We give because we're blessed and we want to be a blessing. We believe we're using these resources the way they're intended. However, if you are concerned with, hey, I would really like to figure out how to possibly make this to where it's tax deductible and lower my overall tax liability, there is a strategy where you consider, if it makes sense, doing a couple of years worth of gifts all at once. That's where it's called or considered bundling or bunching. And a great tool to help facilitate this is a donor advised fund, a DAF. A donor advised fund, in simple terms, is like a charitable checking account that you could make these gifts to and get that and have it count towards a particular tax year. But once the funds are in that charitable checking account, you can't take it back, but you can disperse these grants to these charitable organizations as you see fit, when you see fit as well. If you're retired and you have retirement accounts, if you're over 70 and a half and you have pre-tax traditional IRA money or possibly old pre-tax 401k money, qualified charitable distributions could be one of the biggest opportunities for your generosity. A qualified charitable distribution is where you gift money directly from your pre-tax traditional IRA to the charitable organization. And if you do that, it's considered a distribution. If you're taking required minimum distributions, it can count towards your RMD. So that's nice. But it's using pre-tax money to go towards a charitable organization. And as long as you notify your tax preparer and it's coded as a QCD on your tax return, please note your 1099s, when you receive those, they do not say QCD. Your 1099s just say, hey, you took money out of your IRA. You have to let your tax preparer know that part of this money or all of that money was a qualified charitable distribution. And if so, when they report it, then it gets excluded from your income. So it can lower your AGI, which could be beneficial possibly for some folks that maybe are paying higher Medicare premiums. But it can also be beneficial in the fact that if you're lowering your AGI, you're lowering your taxable income and maybe still claiming that the high standard deduction. Wow, you just used pre-tax money and you lowered your income tax bracket, or you lowered your income and you're still claiming this high standard deduction. You may be decreasing your overall taxable income and lowering your tax. And you're giving at the same time. And I want to say, I am patriotic. I love America. We're super blessed to be in the US, but I don't necessarily want to spend more in taxes than I need to. Because the more money we preserve, that's more money we can give. That's more money we can bless others with. Same thing with the Roth conversions and family tax bracket management in terms of wealth transfer. I don't want the IRS to be part of my legacy. I want my kids, my grandchildren, charitable organizations I care about. I want them to be part of my legacy. So think about the QCDs. If you're in your Sunday school class with a bunch of fellow retirees, ask everybody, are you doing qualified charitable distributions? If the answer is no, then, ask them why not. Help explain what a QCD is, or point them to their financial planner, their tax preparer, or here at Steward Wealth Strategies. We love talking about generosity. So the Tax Cut and Jobs Act that was put into effect a few years ago kind of simplified taxes, lowered rates for the most part. It is going to sunset. So you're going to hear a lot about sunsets over the next 2 years. At the end of 2025, the Tax Cut and Jobs Act will sunset. So at that point, some of these tax provisions, the higher standard deduction, some of these tax rates will go away and we'll go back to where we were. Please read the special tax report that we've included with this webinar. So we don't want to just think about what we're filing today. We want to think about the future. We want to be proactive with our tax planning because small decisions today could lead to huge rewards and benefits later on down the road. And if you find that information helpful, share it. Forward this webinar on. Share that tax report with a friend, a family member, a coworker, a fellow retiree that you think could benefit. I will tell you, Roth conversions, QCDs, donor advised funds, Secure 2.0, the Tax Cut and Jobs Act sunsetting. These are things we all need to be aware of. Whether we act on them or not is one thing, but at least having the knowledge and the understanding of knowing what the opportunities and options are, that's critical. Our mission statement here at Steward Wealth Strategies, we want to help you, our client. We want to help you get the most life and purpose from your wealth. You all have your own set of goals, objectives, concerns. We want to help you develop financial plans and manage your financial plans and your wealth so that you can enjoy what you've been blessed with and help you be a good steward of those resources. So our best clients come from you, our existing client. So if you know somebody that you feel would benefit from this information or even a conversation, please connect with us. Thank you. We're honored to have you as our client. We're honored with how you continue to bless us here at Steward Wealth Strategies. I hope this information was helpful. I hope you're leaving this thinking not just about 2023's tax returns that we're all currently or we have recently filed, but hopefully you're thinking about 2024 and maybe even beyond. Because remember, would you rather do proactive tax planning or reactive tax paying? Thank you so much for the opportunity, and thank you for investing some time today. God bless you.